Welcome to Finance in 10, where complex finance meets clear, simple storytelling. Let's dive in. What is a financial bubble, and why we never see it coming? Imagine buying a tulip bulb, not a flower, not a garden, just a bulb, for the price of a house. Sounds ridiculous, right? But in the 1600s, this actually happened in the Netherlands. It's known today as the Tulip Mania, and it's considered the first recorded financial bubble in history. The truth is, financial bubbles are not just historical anomalies. They keep happening, again and again. .com, housing, crypto, every time people say, this time is different. But it never is. So what exactly is a financial bubble? Why do we keep falling into the same trap? And more importantly, how can you recognize one before it pops? That's exactly what we're going to explore in this video. This isn't just about history. It's about psychology, risk, and the repeating patterns that move entire markets. Let's begin. At its core, a financial bubble is a cycle of rapid asset price inflation followed by a sharp contraction. But the tricky part is, most people don't realize it's a bubble until it bursts. Here's how it usually works. A new idea or innovation captures attention. Optimism builds. Prices start to rise. More people jump in, not because of the value, but because of the rising prices. Greed takes over. Fear of missing out, FOMO, replaces logic. Prices reach irrational highs, completely detached from fundamentals. Then, one trigger, just one, causes panic. And then, everything crashes. The bubble life cycle. Economists often describe bubbles using a 5-phase model. 1. Displacement. A new technology or trend captures public attention. 2. Boom. Early adopters profit. Prices begin to climb. 3. Euphoria. Everyone wants in. Valuation stops mattering. 4. Profit-taking. Smart money exits quietly. 5. Panic. The crowd realizes the illusion and runs. Sound familiar? Let's look at one of the most famous modern bubbles, the .com bubble. In the late 1990s, the internet was exploding. Investors believed any company with a .com in its name was destined for greatness. Valuations skyrocketed. Some startups with no revenue or product were valued at billions. Take Pets.com, a company that raised over $80 million in its IPO and went bankrupt just 268 days later. By 2000, the Nasdaq crashed, wiping out $5 trillion in value. Companies vanished. Retirement savings disappeared. And yet, almost no one saw it coming. The psychology behind it. Why do we keep falling for bubbles? Because it's not just about finance, it's about human behavior. We follow the crowd. That's herd mentality. If everyone else is making money, we assume we're missing out. We seek confirmation. That's confirmation bias. And in a bubble, the loudest voices say, buy. We think we're different. That's illusion of control. We say, I'll get out before it crashes. But most never do. Every bubble has its own version of, this time is different. In 2007, people said the housing market couldn't fall. In 2021, some said crypto was untouchable. But bubbles aren't about what's new. They're about what's timeless. Greed, fear, and hype. Spotting a bubble. Is it even possible? Here are red flags. Prices rising much faster than fundamentals. Media praising risk takers. Leverage increasing. Borrowed money everywhere. That same old phrase, it's different this time. Spotting a bubble takes discipline and doubt, two rare things during hype. So, what can you do? Ask, would I buy this at half the price? Don't confuse momentum with value. Stay diversified. Never bet everything on one asset. Study history. It doesn't repeat, but it rhymes. The first known bubble, Tulip Mania. In the 1600s, tulips were a luxury, but demand turned into obsession. At the peak, one tulip bulb was exchanged for a pile of valuables, even entire households. Some investors sold homes, businesses, even dowries, just to get in. Then, almost overnight, demand vanished. Prices collapsed. Fortunes were erased. What's wild is that 400 years ago, the same emotions drove it. Envy, FOMO, greed, and the belief that this will never end. The housing bubble of 2008. It began innocently. Interest rates were low. Lending was easy. Banks issued risky mortgages to borrowers with no income or credit. These were bundled, sold, and rated as safe. Prices soared. House flipping became a trend. It felt like free money. Then borrowers defaulted. Banks failed. Lehman Brothers, a 158-year-old giant, collapsed. Global losses? Over $10 trillion. And still, many said, no one could have seen it coming. The rise and fall of crypto and NFTs. In 2021, meme coins like Dogecoin and Shiba Inu soared, fueled by tweets and TikTok. NFTs, digital ownership certificates, sold for millions. Some had utility, like art royalties or access passes. But most? Just hype. Some investors mortgaged homes, emptied savings, and borrowed just to get in. Then came the crash. Billions vanished. Blockchain might still change the world. But when price outpaces purpose, that's a bubble. The crowd is often wrong. Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." But that's the trap. Social media and speed. Today, bubbles inflate faster than ever. Why? Algorithms. Social media amplifies hype. The loudest voices rise. Doubters get drowned. Emotional peak, dopamine and risk. Financial bubbles thrive on dopamine. Watching prices rise feels like winning a game. But remember, markets aren't casinos until we treat them like one. Final thoughts. Bubbles aren't just financial events. They're human ones. They reflect our hope, greed, fear, and our blindness to patterns. Understanding how they form and why we rarely see them coming can protect you not just as an investor, but as a thinker. Because in finance, as in life, the biggest risk is believing, it won't happen to me. A bubble can destroy a fortune or build wisdom. It depends on how you respond when it pops. Thanks for watching Finance in 10. If you learned something new, like, share, and subscribe. And I'll see you in the next one.